Welcome to the latest edition of the JMI Wealth monthly video series. Now, we're filming this in early April, having now posted all the data and all the numbers for the first quarter of the year. Now, last time we spoke, we'd just witnessed the fairly unnerving collapse of SFB Bank in the US, and in the days that followed, a further bank, Signature Bank, was also taken into administration by federal regulators, and these events were the catalyst for increased inspection of troubled financial students elsewhere. This in turn resulted in a collapse in the Credit Suisse share price, prompting Swiss authorities to step in and engineer a takeover of Credit Suisse by another Swiss bank, UBS. So these events have thrown the spotlight on fragilities within the US banking system in particular, and it's the regional banks in the US have been hit hard, both in terms of their share prices, which are lower, but also they've seen deposit flight to larger financial institutions. And it's important to differentiate what's happened over the last few weeks from the situation that we saw at the time of the GFC, or the global financial crisis, when cracks in the subprime mortgage market caused the whole global financial system to undergo a liquidity and a confidence crisis. SVB Bank was undone by poor interest rate risk management, caught out by the incredibly rapid rise in interest rates over the last 12 months. And at this stage, there's no compelling evidence that this problem is a systemic one. But these events have unnerved global financial market. It's thrown a great big curveball at central bankers around the world. So those guys, the central bankers, they've been primarily concerned with reining in rampant inflation, and their key weapon in that battle has been to lift short-term interest rates, hoping to slow demand and in turn slow down price inflation. The banking crisis, though, has thrown their other main objective into stark relief, that of ensuring financial stability. Historically, markets could reasonably be expected to see central bankers use monetary policy tools in similar situations. But right now, that risks giving away the gains that have been won by the increase in interest rates, because we've seen loose monetary policy and quantitative easing has been replaced by tighter monetary policy and quantitative tightening. So central bank announcements in the past few weeks have been really eagerly awaited. So far, the central banks have maintained their commitment to combating inflation despite the financial stability concerns. And in practice, this means they've kept their foot firmly on the monetary policy pedal. And we've seen the ECB lift the policy rate in Europe. We've seen the Federal Reserve in the last few weeks have increased the Fed funds rate. Across the Tasman, the RBA's lifted the cash rate. And even the Swiss National Bank lifted the benchmark rate there despite the collapse of Credit Suisse right on their own doorstep. Financial markets have had time now to react and to assess to the banking ructions. We've seen a couple of significant developments. Firstly, in the US, in response to the turmoil, credit conditions have tightened. So that means it's harder to borrow money. The Federal Reserve commented on this and noted that this actually does some of their work for them, because in practice it means they might not have to raise the Fed funds rate as much as they had previously been expected to. So financial markets have lowered their expectation for where the peak will be in the Fed funds rate, and are speculating also that interest rate cuts may come into play earlier than expected. And although inflation is still much higher than the Fed would like to see it, recent data outcomes have indicated that inflationary pressures are moderating. Inflation is also moderating quite significantly in European jurisdictions, and term rates, that's longer term interest rates, have broadly fallen pretty much around the world. And this has given a real boost to those market sectors that are more sensitive to interest rates. So we can see this really clearly in the NASDAQ index in the US. That's rallied really strongly in the first quarter of the year, posting a 17% gain through to 31 March. In contrast, big blue chip companies, represented by the Dow Jones Industrial Average, have only posted a 1% gain, quite a difference. The benchmark S&P 500 index has given us a 7.5% lift in the first quarter. So you can clearly see the differentiation between the different sectors. Investors with diversified portfolios will also be cheered by the rally in interest rates that we've seen, which means that the fixed income parts of those portfolios are also showing gains, which is good to see after the tough time last year when interest rates rose by far more than we had seen for decades. Our local market has participated in the rally as well, although to a more muted degree. In the first quarter, the NZX 50 index gained 3.9%, and the local bond market index gained 2.4%. These gains are positive news again, following last year's negative outcomes. Look, we've been cautiously positioned with our model portfolios and with our other portfolios with exposure to share market assets at levels below our long-term strategic asset allocation positions. For the moment, we're holding that position. The fixed interest asset class, where we're overweight, is delivering pleasing returns. And we aren't out of the woods yet, with inflation around the world at far higher levels than central bank targets. So we think it's premature to expect monetary policy to pivot. And we don't think we'll see interest rate cuts for a while yet. So growth and demand is going to slow, and unemployment is going to rise. And these are all headwinds for corporate profitability. But we are starting to see just the potential for a light at the end of the monetary policy tunnel. And that prompt and decisive action by regulators in the US and Europe have addressed for the moment the financial stability concerns. But some caution is still warranted. Look, we know these are unsettling times. Through that, though, the rationale for having a diversified portfolio of good quality financial assets still holds true. And I say it again, we believe now more than ever there's value in having access to an experienced financial advisor. So look, don't hesitate to contact us. We welcome the chance to talk through some of the current market issues with you. Look us up on jmiwealth.co.nz, or you can always follow us on Facebook or LinkedIn, or even give us a call. We'd love to hear from you.